Hello again, and welcome to the Cane Toad Investment Channel, the second in my series of investing in bank shares and risk. So what I don't want you to be is one of these. Don't be an investment bunny. The way I'm going to describe how I think about bank capital is as follows. So imagine you've got a bank, a hypothetical Australian bank which has got $100 billion in assets. That's money it's loaned out to its borrowers. It's got $90 billion in what it's borrowed to fund those loans that it's made to its borrowers, its assets, and it's got $10 billion in capital. And recall that the accountants will tell you assets minus liabilities equals capital. Remember that equation if you want to. Now think about your own home. Imagine for a second that your home is worth $1 million and you've borrowed $900,000 to fund the purchase of your home, and you've got $100,000, or you've had $100,000 in capital or your own equity, which you've directed at that purchase of your home for $1 million. Now imagine the value of your home falls to $950,000. The bank's going to go, hang on, we thought that you had 10% of equity in your home, but now that the asset's fallen to $950,000, you haven't got 10% equity anymore, you've only got 5% equity. You need to sell your car or hit your parents up for a loan, or a gift, I should say, of $50,000 to bang on that loan, get the loan down so that the loan to valuation ratio stays back at that 90% level that the bank's comfortable with. Same thing for our hypothetical bank. Imagine for a moment that there's some economic calamity, deep recession, depression, something along those lines. Imagine that, and imagine that the value of the bank's assets falls because people lose their jobs, they can't repay their loans, and the banks have to foreclose or write off a whole bunch of loans. Imagine the value of the loans falls from $100 billion to $95 billion. Then what APRA is going to say, APRA's the mob that regulates the bank, they're going to say, yo, we still need you to have 10% capital backing those loans. You need to find $5 billion more capital to pay down your liabilities so that you preserve your 90% loan to valuation ratio. Now, recall that banks, that hypothetical $100 billion bank might make a return, net profit after tax return on assets of 1%. It'll make approximately $1 billion a year in profit. So if it has to raise $5 billion capital, then that's 5 years profit up in smoke. That's what I wanted to point out. That's what I don't see focused on in the sell side research so much, is the risk to the bank's capital and what the bank might need to do to respond to pressure on its capital in a calamity where there is elevated unemployment for a period of time. Now, that's all I wanted to say in this video about the risks of banks and the bank capital. Next video I'm going to talk about the risk to investing in banks connected with banks' earnings and dividends. Thank you for listening and watching, and stay healthy.